Here are three checks your life insurance policy should pay out in case anything was to happen to you if structured properly. Your first check should be for funeral expenses. Usually with your life insurance policy, you get 10% of your sum assured to cover funeral expenses. It may vary from company for company, but it's usually 10% of the amount that you're insured for. The second check that your life insurance should pay out is your debt liquidation check. So if it is you have a mortgage or you have any loans, debt shouldn't pass from one generation to another generation. So your life insurance should have a check just to clear off all the debt that you have so that you're leaving your family in a position that they are debt free. And your third check, which is probably your most important check, is your legacy check. This represents the last paycheck that you're going to leave for your family. Or your legacy check should be at least 10 times your annual salary. So to break this down further, let's take a look at this video. So let me show you why you should structure your life insurance to pay out three powerful checks. So in this video, we're going to look at a case study. Let's say it's a husband and wife, Jonathan and Rebecca, and they have a joint mortgage of $1.4 million. They have two children, and they have a combined income of $30,000 a month. For simplicity, we're going to break it down to $15,000 each. Now, Jonathan and Rebecca are taking the same plan. I'm going to break down how we structured the life insurance to pay out the three checks. So the first check, this is going to cover funeral expenses. Basically, this is a life insurance policy for $50,000. This could cost you roughly about $35 a month. This will cover funeral expenses if Rebecca was to pass or if it is Jonathan was to pass. The second check or the second life insurance policy is going to be a debt liquidation check. This represents $1.4 million for that mortgage that they have for $1.4 million. Now, this is to clear off the mortgage in case any of them was to pass away. That means that if it is Rebecca was to pass away, the burden doesn't fall on Jonathan to continue paying the mortgage, or if Jonathan was to pass away, the burden wouldn't fall on Rebecca to continue paying the mortgage. What happens is most people stop here. They give the bank their life insurance policy to clear off the mortgage, and that's it. There's a third and the most important check, which is the legacy check. What is the legacy check? This represents the last paycheck that you're going to leave for your family. How much should the legacy check be? Roughly, a legacy check could be 10 times your annual salary, which is $106. Let's say it's $15,000 a month. 15,000 by 12 is 160,000 multiplied by 10 is $1.6 million. Then we have the debt liquidation check for $1.4 million, and the life insurance policy or funeral expenses check is for $50,000. Your total coverage is $3 million, roughly a little over $3 million. And let's say the monthly contribution for this could be roughly about $700 monthly. Now, of course, we're using term insurance to do this. The reason why is because term insurance gave you the coverage that you need now at a price that they could have afforded. So this is how they structured their life insurance. 1 is for funeral expenses, 2 is to clear off the bank, and 3 is for their legacy check, which will be the last check that they're leaving for their family.